Hi folks, my name is Matthew Harrison. I'm a farming systems scientist at the University of Tasmania in Australia, and in this webinar we'll be looking at the calculator called WaterCanProfit. It's a calculator that we've built with agronomists, farmer groups and farmers all across Australia in irrigated discussion groups. So there's three parts to the app. There's a water price app, there's an optimizer app, and there's the investment part. I've talked about the water price and the optimizer part in different webinars. Today I'll be talking about the investment app. Basically the question is long-term strategic financial decisions. If I've got one form of irrigation, or if I've simply got a bare paddock of 100 hectares or so, or whatever the area is, what's the most profitable form of irrigation? How long does it take to pay back? And what's the net present value or greatest profitability over the long term given the expected life of that irrigation machinery or infrastructure or whatever it is. So basically you can contrast many different sorts of irrigation infrastructure by using this investment analysis. And in our work we've found that a lot of, and no need to be ageist here, but a lot of younger farmers are particularly interested in this investment analysis, particularly those that are starting out. So just a little bit of housekeeping. If you hit this button here, you'll always come back to this screen, this actual icon. You can hit these here and you'll go into the different apps. Before you start, you'll have to log in. So to log in, you need to register. It takes about 2 seconds. You put in a username and a password. It will email it to you, and then you're done. Okay. There's an exchange button, but I'll talk about that in a different webinar. So then you click on investment. Now, the way you use WaterCanProfit is you work through these items step by step on the left-hand side. So start at the top, then you work through them, and you go through the bits and pieces to finally get to the compare, which is the output. Okay, so then you have a number of scenarios. These are examples. You can create any example you like. You can create 100 if you like, or you can delete them all by hitting that red button. If you want to reset, you hit this hammer icon. And if you want to add a new scenario, you hit that plus icon and it'll add another one. So if you want to create a new one, you might do it by copying an existing one. My scenario is new investment analysis. Or you might do it something more intuitive. For example, border check investment or similar. And then you might say, well, okay, so what area am I intending to irrigate? Okay, so we're talking about Australia, but you could be anywhere in the world. This might be 100 hectares, okay? If you're in America, you'd convert that to acres. So here we have the productive life. Now, a border check system, it could, 20 years might be a realistic time, so you enter years, you've got a little spinner at the side there. Your bank interest rate, okay, so interest rate might be 4%, for example. Costs of capital investment. So you can enter it in total dollars or in dollars per hectare. So because you've got 100 hectares here, you might have it might be a $400,000 investment. Or you might say dollars per hectare and it will convert it. So it's done 400,000 divided by 100. So it converts it for you. Other capital costs. So that could be machinery for new crops, vehicles, workshops, sheds. You probably want to be realistic there. It's important that you do those calculations. It will calculate total capital costs in dollars per hectare per year. Then you have your total overhead costs. So what do we mean by overhead costs? These are fixed annual costs that are not directly related to the investment, such as repairs and maintenance, energy, wages, and so on. Again, you can have dollars per year or dollars per hectare per year. And then you have your water cost. So you can use the spinner there. That's actually the cost of getting the water there. It's not the cost per se of the water. Okay, so it's the actual cost to get the water to your paddock or your field. Okay, that's all we do for that initial page. Now we have the crops. Then we have the calculation, which shows the outputs. Then we have the compare. So we only have 2 inputs here. Now, in our work with farmers, we've found that there's 2 main ways that people that make investment decisions, and it's through, an important one is rotation. So we've reflected that in here. So we've got crop type, year 1, year 2, year 3. You can change that or add or do whatever you like. The second thing is markets. So they not only yield but variable costs and prices. So that was a very important one. Okay, so in any given year, you might just have one crop type, just to keep it simple. You put in the area of the percentage of the farm. So in any given year, you might have, and you actually use the optimizer app to determine what's the most profitable combinations of crops in any given year. But you might just say, for simplicity, in the first year I sow 50% of my farm as cotton, 50% of it as wheat. Okay, well that probably doesn't make sense because cotton is a summer crop and wheat is a winter crop. But let's just say they were, well, we could say this is barley, for example, and they're both winter crops. You're sowing them at the same time, so it's both winter crops. Then you put in your price. Okay, so these are for cotton, which I've just changed it from, it would be dollars per bale, but for barley it's dollars per tonne. So you can either scroll down or you can pull it down, mouse down and actually pull it down. So if we pull these down, so you put in a low, a likely and a high price. So we pull these down. For barley you don't get much, not in Australia at the current time anyway. If you go down to 200, 280, about 325, so you probably should check those prices. Then you put in irrigated yields. So for barley you might have 3.5, 4, 6 tonne for a very high yield. Now, these look a bit different because we've got this thing switched off. So you can switch that on and you can enter the low and the high, or you can switch it off and just enter the likely. So if you enter the low and the high, you'll get a distribution of outputs, and the outputs are much more accurate if you have these ranges switched on. Okay, just for the sake of simplicity and because we're doing a demonstration, I'll leave these off. So put in your variable cost for barley. So this was for cotton, so I'm going to take this down. And it's saying, variable cost for barley, well, it could be 500. Okay. Now my water applied for barley, what you would do is you'd put in the lowest yield, the likely water applied, and the highest water applied. Here I'm just going to show an example, so it might be, the typical water I apply to barley might be 3 megalitres per hectare. That's fine. Then you just go ahead and do the same for the other crops, so barley, wheat, cotton, so on and so forth. You might say, well, barley's not the first year in the simulation, it's actually the second year. So you could say that's the second year, that's wheat is the third year, you can change it there, or you could say they're both in the first year, so they're both, that's why I've got this 50%, or you can change it here, so you can hit down and it's flicked all of them down. So there's multiple ways you can move it around. And then this button here actually replicates. So you might say, well, I've got maize 100% in year 4, but I might copy that crop and I've got it again in year 5. So 2 lots of maize. So you can create a rotation as long as you like. Important to try and get these numbers as realistic as you can, because that will have a big effect on the results. And that's it. Then you just hit calculation. It will take a little bit of time in some cases because there's a lot of calculations happening here. So what it does is it calculates for 40 years ahead. So assuming 2020, it's got your crop type, the yields of them, price, variable cost. It's got your net cash flow and then your cumulative cash flow. Okay, so that's accounting for your initial investment in dollars per hectare. How long does it take to pay back? Now this looks bunched up here, but that's because we're doing barley and wheat in the same year. It's showing the yield of barley and the yield of wheat given the numbers you put in, the price, the variable cost, your gross margin, your cash outflow, your net cash flow and your cumulative cash flow, net cash flow. Down the bottom is the most important thing. So after 40 years, your cash flow is negative. So your present value of net cash flows, so basically what's it worth after 40 years in future terms, because your interest rates will change, negative 2,800, that means you're making a loss. The payback period is not a number, NAN, that means it can't calculate it. So given that they're negative, we might go back and have a look at the numbers to see if we actually did put in realistic numbers. Okay, so you probably would expect it to be positive. It may not be. Okay, so let's just have a look here. So the price of barley, 210, 280, 325. Well, a typical barley price might be 305. A typical irrigated barley yield might be more like 5.5, and a high barley yield might be 7. Okay. Now wheat, well, in a typical year we might have $300 a tonne. In a high year it might be 340. Yields for wheat look appropriate. Okay, so variable costs. Okay, so variable costs for barley are too high. That's probably the big problem there. So if I pull this down, and the reason for that is because I copied that from cotton before. Now, if I do this here, I change this to $300 a tonne. Hit OK. Not $300 a tonne, $300 a hectare. I'll go back here, and so that looks much more realistic. I'll just go back here and click down there again, and it's interesting. It's actually gone back to 1185, so it's defaulting to that cotton example. So what we might do, that's actually probably because I changed it from cotton. So what you should do is you should start from scratch, create a new crop. So I'm going to delete that one because I've caused a bug there. I don't want to take time to set it up again. Now what I'll do is I'll go back here, hit calculation again. Now we can see that barley has gone. Now the present value of future cash flows is negative. Okay, so you might say, well, why is that? So let's have a closer look at the numbers here. So in the initial year, that's our initial investment. Okay, so that's fine. $4,000 a hectare. That's actually quite a lot, $4,000 a hectare. So that's probably why we're negative. Then we've got a cash flow of, in dollars per hectare in the first year, of negative 1581 for wheat. Okay, so that indicates that something's wrong there. So the actual cost and the price and the yield in the first year, there's something not quite right there. So it shouldn't be negative 581 actual cash outflow. It should be, I suspect that should be positive. This number is fine because it's accounting for that capital flow, and this one is adding them all up. Okay, so in that way, so here we're getting positive numbers. So our gross margins are positive. So what that's showing us is that cotton, for this environment and for the numbers that we've put in, cotton is the only profitable crop. So maybe you should go back and check your numbers. That's what it's indicating to me. So I'll just do one more example. I'm a bit concerned about why this wheat is negative. So I'll go back here. Now I'll have a look here. And the reason for that is because I'm only putting in 50% of the farm, most likely. So if I put in 100, I'll change this. Now we had a gap in the rotation, so that was another problem. So I change this to year 2, change maize to year 3. I'll delete that maize crop, and I'll delete that one there. Now, so we should only have 3 crops. Okay, so the yields for wheat look quite good. The actual variable cost for wheat look to me to be a little bit high. So I'll probably lower that down a bit. So I'll leave so the lowest one's probably much lower and the highest one's probably higher. Okay, so that probably looks realistic. My yields just changed because I clicked on it. 4, maybe 5. Maybe 8. So it's a high yielding environment. Remember, these are irrigated yields, and the record rain-fed wheat yield, I believe, is about 15 tonnes per hectare. So these are quite conservative numbers. What I'm concerned about is when I click across whether these numbers actually change, but I think it's okay. So if I go into calculation, if I go down here, click down here first, I'm wanting it to recognise those numbers. Okay, so if I go down here and click calculation, okay, so it has changed, right? So the numbers that I did do, now we're getting a net cash flow of $49 a hectare. Still not much. Still indicates we haven't quite got the balance right. probably the thing to indicate there is not the numbers are not really important, but what is important is the process that I'm doing in checking and going backwards and forwards. So I'm looking at the number, that's not realistic, go back, change my numbers for wheat, go back again and check it again. So in that way you actually come to a realistic number, and that's similar to using all calculators and decision support tools. Now we've got a positive net present value of 11,200. So the final number that you get will be very much dependent on the individual crop values that you put in. So important to go backwards and forwards like I've done there and ensure that you're happy with all of those. Look carefully at the net cash flow. If it seems low, usually you've got something wrong. If it seems excessively high, you probably have something wrong. As a general rule, cotton is very profitable in Australia. So the maize ones there, I'm not going to touch this, but there looks like there's something wrong there as well. Okay, so this is probably the most important thing down the bottom here. The present value of future cash flows is about $11,000 a hectare. The internal rate of return is how quickly it takes to pay back your current investment. So the higher that is, the quicker you pay back, and the payback period is 4 years. Then we go to compare. Okay, so what compare does is if you only had entered one scenario, it would only have one of these box and whisker plots. Here's the one that we just entered. Okay, so these are previous examples. Now, all of those dots are randomized samples. The middle line is the median, so it's the middle number. That's the number you should look at and compare over here. So it's that 11,000 number. The length of those whiskers, so to speak, is the distribution. So the lowest present value of future cash flows is about 9,000. The highest is about 14,000. So if you look at the middle number compared with some of these other investments, for that one we entered, it's much, much lower. It again indicates one of the crops that we had was too low. But basically the idea here is to compare the medians and also the range to determine the risk. Okay, so you can look at different metrics. You can look at investment worth. It'll take a little time to respond. You can look at internal rate of return, which will probably be much different, and it is. So so what this is saying is that your internal rate of return for the flood-based system is much quicker and much greater than all of the other investments. So it depends on what you're looking at. If you want to pay it back as quick as possible, as in as short as possible time, you'd be wanting for something, as low as possible, like this one. If you've got a high payback time, it takes a long time to pay back. Okay. There's one other thing that I want to show you before we go, and that's if we go back to scenario, you might say, well, I've got this one here, but what happens if I actually had spent it, one of these numbers had changed? Well, you can compare it directly. You hit copy, okay? Now, let's just say that, well, I've got a $400,000 investment compared with a $300,000 investment. So we'll call this low price. Low price. We'll change this to 3,000. Leave everything else the same. Just make sure that you don't change anything because we only want to test the effect of this capital costs. That's all. Okay, so it's 3,000. Everything else is the same. Let's go back to calculation. Okay, that's fine. Low price. That means we're on the right scenario. Compare. So it didn't have a lot of effect on present value of future cash flows. Right now we might go back here again to scenario. You might say, well, we'll put that back to 4,000. What happens if my productive life, high life, so is actually 30 years? Okay, so it lasts for another 10 years. Everything else the same. Go back to compare again. Let's have a quick look at this. That had a much bigger effect. So it's saying that your profitability is larger if it lasts for longer. Okay, so it's a bit more sensitive to that variable. What happens if my interest rates are lower? Okay, so we'll go back here. Low interest. So we'll say, just as an extreme example, 2%. You get a good one. Make sure you change that back to 20. Everything else the same. Go to compare. And again, it had a positive effect. So in that way, you can compare which factors are sensitive and which aren't. So thanks very much for watching. Feel free to send me an email, and I can send you a free link to WaterCanProfit if you send me an email. Thanks for watching. Cheers.